Jack. Good afternoon, ladies and gentlemen. Welcome one and all to the inaugural Future Generation Investment Forum. I'd like to acknowledge board and committee members of Future Generation Investment Company, FGX, and Future Generation Global Investment Company, FGG. Also, our fund managers from both companies, shareholders, our charity representatives here, brokers and planners, our pro bono service providers who have come along as well, and all others who are joining us. I'm Louise Walsh, the CEO of the Future Generation Investment Companies, FGX and FGG. I'd like to acknowledge the Gadigal people on whose land we are meeting today. This happens to be, I think, the biggest event that we've done for Future Generation so far. It's still early days. We're coming up to our third year. And we're hoping to fill the venue as the latecomers come in as well. Just so you know, we're actually live streaming this afternoon's forum, thanks to our pro bono service provider, Livewire, and it's also being recorded for later viewing via our brand new website, futuregeninvest.com.au. Please use the hashtag FG Investment Forum. We definitely encourage social media, especially Twitter. So what's in store this afternoon at our inaugural investment forum? Firstly, you're going to see and hear 5-minute presentations from 12 of our best performing fund managers with their best 1 or 2 stock picks or investment ideas. It's a bit like speed dating, but obviously it's not one-on-one. It's strictly 5 minutes each, and the fund managers will receive a warning bell at 4.5 minutes, and obviously another bell at 5 minutes. So it'll be a bit like a case of the old red faces, for those of you that remember, hey, hey, it's Saturday, if any of them go over that 5 minutes. So look out, fund managers. 1 slide per fund manager, and if a fund manager is presenting 2 stock picks, they'll be entitled to 2 slides. Your programs have some space in them for notes on the various stocks that you're going to hear about this afternoon. The slides you will see from the fund managers won't actually be available after today. So if you like, please take a photo of them as they're showing up on the screen. I know I happen to do that at conferences these days when I see something interesting on the screen. There's no Q&A from the audience, I'm afraid. We simply don't have time. But you can certainly contact a particular fund manager if you like on the back of this afternoon, via their website, or grab them in one of the breaks or at the end of the forum if you're lucky and they haven't darted away. Session 1 will have 6 fund managers presenting, and we'll then have a quick afternoon tea break at 1:30 or thereabouts, and we'll come back in at 2. It'll be a bit probably crowded out there, so bear with us. Session 2 will run from 2 to 3 p.m, and I've got the hard job of trying to keep us on time for the afternoon, including myself. Founder and director of FGX and FGG, Jeff Wilson, and I will then present an update on the companies at 3:30 until 4 o'clock. So anyone can stay on for this afterwards, even if you're not a shareholder of FGX and FGG, and before that we'll have a short break. The FGX AGM will then commence at 4 p.m. and be immediately followed by the FGG annual general meeting at 4:30, and we'll certainly have the day completed by 5. I'd now like to call on the founder and director of FGX and FGG, Jeff Wilson, to say a few words of welcome. Thanks, Jeff.
Look, thanks very much, Louise, and thanks for everyone who's come today. Obviously, your FGX and FGG shareholders or WAM shareholders or guests. Future Generation, both entities, FGX and FGG, were created as a way of the investment community and the finance industry to give back to the to the community we live in and operate in. And to me, they are incredibly good vehicles from an investment perspective, and And the only reason that is possible is because the generosity of the fund managers, and you'll see 12 of them here today. And I can't thank them enough for what they've allowed us all to achieve. You know, we've got the two entities combined, you're talking about 700 million of assets. And as you know, fund managers, you know, we like charging our fees, which we would normally get paid to manage that pool of capital. All the fund managers involved in FGG are doing it on a pro bono basis. Not only that, but all the service providers are doing that as well. And probably the two largest service providers is the Share Register Boardroom, you know, I can't thank them enough, and the ASX. You know, to me, they're the only two companies in the world, I'd say, where an exchange doesn't charge them an annual listing fee. I can't thank everyone involved enough. And how do the products work? Like, they are a win-win-win. To me, they're a big win for the investor because you're getting exposure to the smartest domestic and global fund managers, and you're effectively getting that for free. You're not paying anything. 1% goes to, in FGX, youth mental health, and in FGG's case, children at risk. 1% of the assets a year, that's $7 million a year, goes to charities that work in those two spaces. It's a win for the charities, obviously. It's a win for the investor. And is it a win for the fund manager? I actually think it is, because it gives them an opportunity to give back. And again, I just can't thank the fund managers here today for, you know, being as generous as they have been. And when we call you soon to get some more capacity to manage money for free, please take our call. Now, why we're here today, when we set up FGX about 3 years ago, I remember Gabriel Radminski, who's one of the fund managers and one of the board members of FGX, said, look, why don't we do a forum similar to this? We've also got David Prescott here, who's one of the fund managers from Langan. Probably around the same time, he was saying, look, why don't we do a conference in Australia similar to the Sohn conference in the US? The fantastic thing is, last year, Hearts and Minds / Sohn conference was put together, which David, I know, inputted into, but Gary Weiss and Matthew Grounds from UBS spearheaded. So these type of days are very valuable for people that are really interested in investing in the market. The difference between this here today, if you're a shareholder of the various entities, you come here for free. If you went to the Sohn conference in the US, which I went to, luckily I got a pro bono seat, that was $5,000 US. And if you went to the conference here in November last year, and I think it's going to be the 17th of November this year, it's $2,750 for your seat. So value your seat. And in terms of the information, obviously, have we done a general disclaimer? Okay. Please don't go and hang the fund managers or even myself if we make a mistake. I'm just going to conclude now, but I wasn't meant to give you one stock, because I know Chris Stott, our Chief Investment Officer at Wilson Asset Management, will give you one stock. But I'll give you one just to put on the ledger, and that's Afterpay. I remember when I was growing up, Mum used to use lay-by a little bit. This is the leader in its field, probably the only one in its field that does lay-by online. And I actually think we could easily, the company, it could be the new REA, it has a lot of the REA type qualities. So that's my pick, Afterpay, and so you can judge me in 12 months' time whether I succeeded or failed. Thanks very much.
Thanks, Jeff. And before we get into it, here's just a little taste of what you could be in for this afternoon, or maybe not. Thanks, if we could just show the very short video. Thank you.
Ladies and gentlemen, Steve Ballmer! Who said sit down? I have 4 words for you. I love this company. Yes!
Okay, well, might be a bit quieter than that, I think, but hopefully you're going to love some companies. This afternoon, with a bunch of fund managers, it wouldn't be complete without a disclaimer. So we certainly have one. Oh, jeez. Oh, no. Oh, okay, there it is. Stole Ben's thunder. Sorry about that. And that's actually on behalf of all of the fund managers, the future generation companies as well. Now I'd like to introduce our first fund manager. And before today, I asked each of our fund managers for a bit of a quirky fact about themselves, because in your programs you'll see we've set out the bios and a photo of each of them, and I thought it would add a bit of a human interest sort of side to each of the fund managers. So Ben Griffiths co-founded the Australian small cap fund manager Eli Griffiths in 2003. So Eli Griffiths is one of our very generous fund managers for FGX, but a couple of quirky things about Ben. He's a life member of the North Bondi Surf Club, and he led the rebuild process for the new award-winning clubhouse. So I'm not sure if many of you have seen it, but hopefully you had. It's a real icon building at our icon beach, Bondi. The other quirky thing about Ben is that his father is a famous entertainer, Harry Griffiths, who in the 50s played young Harry in Mackackie Mansions, a famous 2GB radio series, which apparently every household tuned into in the 1950s. So please welcome Ben.
Thanks, Louise. And I cannot promise I'm going to do a Steve Ballmer dance. I haven't done one yet. I might do one if my stocks outperform in the next 12 months. You can hold me to it, Jeff. I'm going to talk about 2 stocks today in the very limited time I have available. Wrong way. Sorry. All right. Noni B. From Swansea Belmont to greater than 600 stores Australia-wide, Noni B is a revered women's fashion retailer that's currently going through a metamorphosis. Noni B, Rockman's, W Lane and B Me are probably a couple of brands that may resonate with some of those in the crowd. Part of the excitement of this story for us lies in the turnaround strategy that's currently underway. Noni B has probably nodded off in recent years. The new CEO, Scott Evans, who's a Brett Blundy lieutenant, has swung into action. I've dubbed him up there as a retail toe cutter. His job is to get in there, straighten Noni B up, cut costs and get that business back on track. Part of that, of course, was acquiring Pretty Girl from a group of investors, principally James Packer. Part of that is a complete overhaul of that business. CODB, cost of doing business. Basically integrate that business with the current Noni B business, squeeze out synergies, deliver topside growth, go to the supply chain, see how smarter they can source product, see how smarter they can move product around from store to store. And the final point, of course, is organic growth, how they can grow the business themselves, new stores, right-sizing existing stores, and doing that new thing that they're not even doing, which is online sales, an important sales medium. And of course, the next question that often comes to mind is Amazon impact. What are Noni B going to do about the Amazon effect, which has got every investor, big or small, quite concerned about right now? The Amazon impact as they arrive here, supposedly they're hitting town around September. We think what differentiates Noni B in that instance is that it's in client service. It's a real touch and feel retailer. It's for the value conscious shopper. They're everywhere, as we know. It's got a big regional presence, so it does attract and support the retail communities. So we think Noni B is a terrific little story and one that is destined to perform in the months ahead. My second stock today is PWR Holdings. Its ASX code is PWH. These guys are a Queensland-based designer and manufacturer of world-leading car systems and radiators. Not that I would expect too many in this room to have heard of the product or seen it in their car. You won't have seen it in your car. It currently applies or is used in Formula One racing cars, NASCARs, V8 supercars. It's used in the World Rally Championships across a number of the vehicles, and increasingly in the OEMs or the major auto manufacturers. Ford have signed up. We're hoping that more and more OEMs will embrace the technology and go forward. The company's had a challenging last 12 months. Financial year 17 won't have been easy for them. That was certainly the indications at the interim. The profit will be down about 30% this year, and that's basically because they are currently investing in the business for the future, whether it's here or in the United States. And of course also the British pound has been especially weak, and something like 80% of this company's revenues are derived offshore. So if you believe the Australian dollar's going down and you believe that the British pound's going up, that will be a favourable combination for this business's revenue model. So the upside comes from not only the bottoming of the pound, which I think, my opinion is that is happening right now. I see Jack Lowenstein's in the audience here. He may have a counter prevailing view on that. But they hopefully will win more and more major auto companies, the OEMs as I just described them. With any luck, we should see those contracts drop in the next year or two. We think the US aftermarket, where they're establishing a beachhead, should grow and grow successfully. That's our thinking all the same. And as I mentioned, stabilising in the currency. So they're two stocks that we're particularly keen on as a house. They're two stocks that live in our emerging companies portfolio that we've recently launched. And before I hand over to Louise, because I know I've got a bit of time here and I've gone hard, and in the interest of conciseness, I just do want to make reference to one of the constituent charities that resides within FGX is the Australian Indigenous Education Foundation. I caught up with Andrew Penfold the other day and he was telling me about the great work they're doing. It's a charity I was not particularly aware of, and I was thrilled to hear that some 500 scholarships will be awarded in calendar 17. So well done, Andrew, and well done, a great effort to the AIEF. That's it. Thanks, Louise. And I will do the Bulmer dance if my stocks outperform any other fund manager here today. I'd like other managers to also enter the fray.
Thanks, Ben, and we'll hold you to that too. And I know my husband's watching by stream, and he's pretty obsessive about Formula One, so I think he's going to be pretty excited about PWR in particular. So thank you, Ben, for kicking things off this afternoon. Now, second up, we have Sean Fenton from Tribeca Investment Partners. So Tribeca is a fund manager from FGX. Actually, Sean's starring in the AFR, the Australian Financial Review, today as a result of a presentation, some stock picks he did yesterday at our shareholder update presentation in Melbourne. So thanks, Sean, for battling the fog in Melbourne and getting there for us. But a couple of quirky things not so quirky really, but Sean is definitely into wine. He plays basketball and he's a surfer. Sean is the portfolio manager for the long-only Australian equity fund at Tribeca Investment Partners. Thanks, Sean.
Thanks, Louise, and good afternoon, everyone. So hopefully I'll click this the right direction. There we go. So I think we're in a pretty interesting position now in markets. We've had some pretty long bull markets from the GFC with a bit of a sort of Euro-led interruption, but things are getting pretty mature. Interest rates are very low, and increasingly yield's been priced very aggressively, yield and growth. So I thought a good stock pick would be something that fits the contrarian mould. So within that range, Telstra has certainly been a very favoured yield stock across the market, and continues to deliver a very good yield, but it has been under the pump in recent times. So there's some pretty clear challenges for Telstra. Most obvious and topical is the impact of the NBN and the rollout of our national broadband network, and how that impacts Telstra's earnings, both in terms of its voice earnings, which will disappear, and its fixed broadband earnings, which it'll go from being an operator, owner of infrastructure, to a reseller under the NBN model. So that transition will wipe a couple of $2 billion off earnings for Telstra, which is a material impact. The good news for them, though, is they did negotiate a reasonably good payment plan from the government. So the NBN will be paying them circa $12 billion in value for its copper network over time, and Telstra has maintained some ability to service that and generate some revenues. So that's a pretty big challenge for them, but the good news is that there is some money coming in to replace that, and depending on how they use that, hopefully with some stock buybacks, reducing the share count, that will alleviate some of the downward pressure on their EPS and their dividend going forward. But that's not really the end of the pressures for Telstra in recent times. It's been suffering a transition across its voice network for quite a long time as the world's transitioned into a mobile space. And as that's been going on, losses in voice have been offset by some very strong growth in mobiles and broadband. And that really accelerated a couple of years ago, where Vodafone had some issues, and they hadn't invested in their network adequately, and Telstra really got a free hit there. They got some very good subs growth, and they were able to charge a pricing premium as well. So that really helped turbocharge Telstra's mobile growth. And as often happens in markets and competitive markets, the competition responded. So Optus and Vodafone both reinvested heavily back into their network, and that has put some pressure back on margins. So in the last year or so, we've seen price competition start to increase again in that mobile space, and that's capped out the growth and put a bit of pressure on Telstra, along with some regulatory decisions there in terms of mobile interconnect payments. So that's another issue that after some very strong growth, mobiles have taken a bit of a step back. And that's really been topped off in recent months with a potential entrant, or likely entry of a fourth mobile operator there, as TPG acquired some spectrum in a recent auction. So they paid a very handsome price, $1.2 billion from memory, to enter into that market, and they'll spend a further $600 million rolling out a mobile network to cover roughly 80% of the Australian population. So the market was quite severe in its response to this. The Telstra share price really got beaten up on that perceived threat to what had been a stable market structure. Another entrant overseas when we've seen this, even domestically when we had a fourth mobile operator with Three in Hutchinson and Orange, that there was greater price competition. So we look at that and say, yes, there's a risk of increasing competition there, margins being impacted, but in the long term, they're not anywhere near the scale that's been built up in terms of assets and infrastructure, not just Telstra, but across Optus and Vodafone as well. So we don't see TPG being much of a threat in that premium corporate end. Will impact probably a little bit the cheaper prepaid end. So yes, competition's increasing a little bit, but I always like a contrarian investment where, to an extent, the worst case or something close to the worst case is already reflected in the share price. So you've got a very attractive short-term yield from Telstra, fully franked. Yes, that dividend might come under pressure, might be cut, but the company has options, both in terms of buybacks, restructuring its balance sheet, costs out, and underlying that, telecommunications, as you all know, mobiles and mobile broadband and fixed broadband are areas that are going to continue to grow in the economy. So I think now's a good time to be contrarian and take up Telstra. So I think I've exhausted my 5 minutes, and thank you very much.
Thanks, Sean, very much for that. A well-known brand, obviously, in Telstra. So next up, our third fund manager presenting is Jack Lowenstein. Jack is representing Morphic Asset Management, which is our first fund manager up this afternoon from FGG, so Global Equities. Jack co-founded Morphic Asset Management in 2012, and he was previously the Deputy Chief Investment Officer at Hunter Hall. Jack recently completed an IPO for a new ethical fund, or LIC, and congratulations on that, Jack. A quirky thing about Jack, well, he was quick to answer in that he is obsessed about volleyball, and you'll see him down at Bondi Beach very regularly playing volleyball, and I believe even Twitter knows about it. So please welcome Jack.
Hi guys, I'm not going to bounce around the stage despite my bouncing reputation. And Louise was very kind. She asked for a picture, and I actually had to send her a picture that was in the Financial Review of me playing volleyball at Bondi at 6 a.m. That one I hope is going to disappear from the Twitter space. Anyway, so thanks very much. I better click on to the right slide. Look at that. It worked. I'm here to talk about probably what I think I'm going to guess is going to be the cheapest stock we're going to talk about in probably the cheapest market we're going to talk about. And here's the bigger surprise. It's a business that operates in what is the world's cheapest capital city property market. I've been going to Japan for, God, it's scary, 35 years. And I still remember when I first went to Japan how expensive everything was. You probably all have that stuck in your memory. Tokyo must be a really expensive city. Well, after many years of economic underperformance and deflation, it's not expensive at all anymore. To put it in context, property prices used to be some of the most expensive in the world. They're now some of the cheapest. So I'm going to talk to you about a company called Haseko, which builds what are called in Japan condominiums. That means apartments. And they mainly build them in central Tokyo. So here's a real surprise. The average price for a two-bedroom apartment in Tokyo now is just a little more than half the average price for a two-bedroom apartment in Sydney. How the world has changed. Now, this stock is trading on a P of, it says 6 there, but actually gone up a bit since we made this slide. It's nearly 7 now. It's really expensive. And I say it's trading at 7. It's got no net debt. It's actually got slight net cash, and it's incredibly profitable. It has about an 11% operating margin, and it gets a return on equity of around 25%. So it's a really profitable business. The reason why it's so cheap is that the Japanese investor is convinced that Tokyo is in the throes of a terrible property bubble. Property prices have gone up about 2% a year for the last 10 years. That has to be a bubble, doesn't it? It's also gone a bit faster than that of late, but as I said, prices are really cheap. And the real evidence how cheap they are is that whereas in Sydney, when you buy an apartment, it's actually cheaper to rent. You can rent as a proportion of the cost of the apartment much more cheaply than you can borrow the money. In Tokyo, it's completely inverted. In Japan, believe it or not, you can borrow a 90% loan to valuation, 9% of the price of the apartment, at about 1% a year. If you buy that apartment and then rent it out, you get a yield of 3 to 4%. So you can see it's completely inverted. It's a very, very cheap property market anyway where you look at it. But the Japanese are convinced it's a bubble. We're not. And we're also convinced this company is going to keep on growing at a very steady rate. And the main reason for that is Tokyo, which is where this company, by the way, builds 1/3 of all the apartments in Tokyo. It's an incredible proportion. Tokyo is still growing. Japan itself may not be growing, but Tokyo's population is still growing steadily. It's a great sucking sound for the rest of Japan as people migrate to Tokyo. And also what's happening in Japan is that Japanese people, as they age, are moving away from suburban houses to live more and more close to the center of the city in apartments. I think it's a trend we'll see in many cities, but it's really quite late to come to Japan compared to many other Asian cities, but it's now happening very steadily. So we see this as a growth company trading on very low multiples with very low downside. And one of the evidence of downside, if you like, is that Haseko has a dividend. Woo-wee, that's great. They pay out 20% of their profits. It's a very cash-generative company, but they pay out 20% of their profits in dividends, and they still have a dividend yield of about 2%, which in a country where interest rates are virtually nothing, if you're going to take your money to the bank, is quite attractive. But the really interesting thing we think is that even if they stop growing, they'll still generate a lot of cash. And we believe that over time, the pressure on them to raise a dividend is going to be immense. The other thing I like about Heseco is that it's not really a property developer, so it doesn't take a lot of risk. There's people who just build property, and there's people who develop property. Developers have to buy the land and have all the risk of funding it during the development phase. These guys do a little bit of development, mostly just build, but they still, because they're such strong builders, such a great reputation, they actually get to put their brand on some of the buildings. That's a pretty good combination as far as I can see. You don't have to take the development risk, but you get your brand. Do you know what? I might stop. It's been very nice to be here. It's a real privilege. I must say a big thanks to Jeff for including us in both this list and in when we were a very young funds manager in the Future Generations Global team, and I'm thrilled to be here, really am. And I promise I won't just bound on the stage if I win. I'll come back in my swimmers.
I think we'll definitely have to have the photographer for that one then. Maybe Tony Abbott with you, Jack. I don't know. We'll see if he's free, actually. Thank you very much. Thanks for being on time too. Next up, we have Gabriel Radzminski. And Gabriel is the founder and managing director of Sandon Capital, an activist investment management firm. Gabriel is very heavily involved with FGX. He's a board member as well as on the investment committee. So we thank him for his involvement on a number of fronts. Gabriel said to me when I asked him about a quirky fact about himself that he thought his job was quirky enough, and he's the one that tipped me off about that Steve Ballmer video that you saw earlier. So thank you, Gabriel. Welcome.
Thanks, Louise. Thank you for the introduction. I felt like the quirkiness was a race to the bottom, so I think I got out of that quite well. We're talking about two stocks today, two companies that operate in one industry, as well as a company that owns a royalty. The two companies, again, the way we see it, you might perceive them as being very different risk profiles. One is a low risk profile company, the other one is a high risk. The first company is called Iluka Resources. Iluka is a major producer of mineral sands, and I'll talk a little bit more about mineral sands later on in the presentation. But first of all, I'd like to focus on what Iluka does with its royalty. So it owns a royalty over production of iron ore in an area of the Pilbara in Western Australia called Mining Area C, which is operated by BHP. You'll see that when I wrote this slide, it was still known as BHP Billiton, obviously no longer the case. They produce about 50 million tonnes of iron ore a year, and Iluka owns a royalty on every tonne produced. We believe that the royalty itself is particularly ill understood in the Australian market, given that there are no easy comparators to royalty streams, whereas elsewhere in the world there are quite a number of royalty companies that trade, and typically trade at reasonably fulsome valuations. We think that the Mining Area C royalty has the potential to double over the next 5 to 10 years. The reasons for that is that BHP have recently confirmed that a project called South Flank, which is within the Mining Area C envelope, has been slated as the preferred replacement to one of their big Pilbara projects called Yandi. We think that that has the potential to double the production from the royalty area, and because a royalty doesn't require capex from the owner of the royalty, we think it basically has the potential to double that value quite simply. Today we value the royalty as it stands at about $1.6 to $1.8 billion, and that's excluding the South Flank potential. And we've been advocating for quite some time with the company and other Iluka shareholders that the company should be considering a spin-off of the royalty sometime over the next 2 to 3 years as a way of, one, freeing up its capital as part of its capital management requirements as it builds its mineral sands industry, but also simply because within the current portfolio of Iluka, we believe it's materially underappreciated and undervalued by the market. Turning to mineral sands, the mineral sands industry is a reasonably dark and convoluted place. It doesn't trade, mineral sands, titanium dioxide don't trade on any recognised exchanges. It's basically just contracted sales. And typically the mineral sands industry works in a boom-bust cycle. We're now coming out of what we believe is reasonably a trough for that industry, where industrial production weakened, supply increased, demand fell, prices followed. Whereas now you can see this chart up here, which is a chart of the zircon price out of a company called Asia Metals, has been steadily increasing. Producers have been pushing through price increases. There's been reports both from upstream and downstream producers in the mineral sands industry, or downstream consumers I should say, that price increases are going through. And so we believe that there's some very strong tailwinds behind Iluka on the mineral sand side of things. The other company that I wanted to talk about today, which is perhaps the more pure exposure to mineral sands, is a company called Mineral Deposits. Mineral Deposits owns a 50% share in a joint venture called Tizer, and Tizer itself owns a mineral sands mine in Senegal in West Africa, as well as a titanium slag furnace in Norway. The first time I saw a picture of the slag furnace, I thought it was a holiday resort because it's basically built on a fjord in Norway. One side of the picture looks wonderful, then you actually see the factory and it doesn't look as appealing. I wouldn't be able to convince my wife to go there. But basically, you can see from the map that it has its own operations in West Africa. That's the GCO thing up here. It buys product elsewhere and then it refines up here in Norway. The company's gone through some teething problems in recent years, hence the opportunity for us to buy the shares quite cheaply. It has commissioned the new mine in Senegal. These are big, large-scale operations that often have teething problems. They never work perfectly on day one. And there was a reline of its slag furnace in Norway, which caused a hiccup in production. Book value of the company is over $272 million US. And at today's prices, to make it in US dollars, the market price today of around 55 cents represents a market capitalization of around $80 million US. And we believe that it's, on that basis, one of the cheapest exposures to mineral sands anywhere in the world. And the replacement cost of the assets, particularly the slag furnace with new environmental restrictions anywhere in the world, means that the replacement cost is again far superior to book value. Thank you. That was almost skin of the teeth stuff.
Perfecto, Gabriel. I think there's a bit of a sand theme going on here. We've got Jack down at Bondi Beach and the sand mining from Gabriel. I'm just wondering if Gabriel wins here with one or two of those stocks, whether he's going to wear his Speedos along with Jack next year, so stay tuned for that. Next up we have Bill Pidham, and Bill is from Elliston Capital, which is one of our fund managers for FGG. Bill is the investment manager at Elliston Capital, and you'll hear certainly soon from his accent that he's Canadian, so he's mad about ice hockey. He's in the midst of the Stanley Cup playoffs. His team, the Montreal Canadiens, unfortunately though was eliminated in the first round, but I gather he's still watching. So please welcome to the stage Bill. Thank you, Bill.
Thank you, Louise, and thanks for reminding me about the first round knockout. Sorry, I got big fingers. There we go. So I think the best way to highlight the opportunity I'm going to present to you today is to spend a bit of time around the context, around the long-term secular growth dynamics underpinning the Zayo Group. I'm sure most of you in this room own one of these. And don't worry, Louise, I have the ringer turned off. I'm not here to talk about the phone specifically. However, I just want to make a point about how this device and other new technologies and services are driving a long-term mega trend. Did you know a 4G phone generated 4 times more traffic than a 3G phone did last year? And the next generation 5G phone is expected to generate 5 times more traffic than the 4G phone. So what we have here is a 20 times growth in traffic over the next 5 years. And this is creating a very strong growth dynamic in terms of the data traffic growth over the next several years, and a 7-fold increase in mobile data traffic. Another name for this traffic is bandwidth. And as you can see in this chart in the top right-hand side, bandwidth consumption is compounding. Cisco estimates bandwidth consumption will compound at over 20% over the next 5 years up to 2020, and basically double in the next 3.5 years. We're streaming more and more content with services such as Spotify, Netflix, while cloud platforms such as Amazon's AWS and Microsoft's Azure are creating new and exciting business models for new and old companies alike. The thing is, these growth forecasts are just based on existing technology. Who knows what the future will bring with artificial intelligence, augmented reality, and machine-to-machine applications. A lot of this growth will be driven by mobile traffic. And as you can see in the chart, Cisco estimates mobile traffic will grow every year by 53% out to 2020. So I think we can accept that demand is going to grow strongly. And I actually think the risk of this growth is to the upside. So now to the opportunity. Fiber is at the core of this megatrend and will remain so for decades. It is the essential infrastructure that is required to make all this happen. And as bandwidth consumption increases, the strategic value increases daily. I think of it like this: just like cars would not go anywhere without roads, Spotify, Netflix, YouTube, AWS, or Azure would not go anywhere without fiber. And as I talked about earlier, the traffic on this fiber road is growing at over 20% every year. So fiber is the backbone that connects mobile phone towers, buildings, data centers, and increasingly homes. So now to the Zayo story and how we are participating in this mega trend. So Zayo is a strategic holding in our portfolio. And over the past several years, it has been building and acquiring fiber assets across North America and Europe. And this footprint would be extremely difficult to replicate today, both on a cost and time perspective. Zayo's management team have been anticipating this demand driver of fiber for several years, and this has now come to fruition. And we'll see this trend continue over the next several years. So as you can see from the lower picture that just focuses on North America, Zayo owns fiber assets spanning the continent. And while I apologize for how busy this picture is, it just shows how dense and expansive Zayo's assets are. Zayo owns over 10 million fiber miles in North America and Europe, connects over 29,000 buildings in over 370 markets. So while Zayo also owns data centers and provides connectivity services to small and large businesses, the majority of its value lies in its fiber solutions segment, which generates EBITDA margins of around 80%. That's 80%, growing at around 10% annually. As the demand for fiber has been increasing, the strategic importance is being realized in industry consolidation over the past few years. So I just wanted to highlight some of the remaining large players with over $50 million of EBITDA in the US. These include FiberNet, Sunesis, FiberTech, and Lightower. Well, let's pick these off. Over the last 12 to 18 months, FiberNet and Sunesis were bought by Crown Castle, which is a US tower operator, for 17 times and 16 times EBITDA. FiberTech was recently merged with Lightower, and now Lightower is on the market at a similar mid-teens multiple. So what we have now is a setup. Basically now stands as the only pure-play listed fiber owner with national scale in the North American market. We believe this represents amazing standalone equity value to us as shareholders and incredible strategic value to a potential acquirer. We believe Zayo is undervalued today, trading at just over 10 times EBITDA. And remember, those previous multiples were done at mid-teens valuations. This creates an amazing, compelling risk-reward setup for us as shareholders. Zayo's business prospects are underpinned by this incredibly powerful megatrend we just talked about, and also an equally strong management team who are incentivized and focused on generating equity returns for shareholders. So I thank you for your time today. I hope you enjoyed listening to the Zayo story as much as I did presenting it to you. And thank you, Louise and Jeff. I really appreciate you allowing me to present the story today.
Thanks very much, Bill. Very much appreciate that. And it's great to have a stock like that, which, you know, to be perfectly honest, I'd certainly never heard of. And there's some amazing stats there that certainly make you take notice of the potential in that space. So lastly, before we break for some afternoon tea, the sixth fund manager that we'd like to present this afternoon is Graham Hay. And Graham is from Antipodes Partners, who are a fund manager in FGG, Global Equities. Jacob Mitchell founded Antipodes in early 2015, and Jacob was the number 2 man at Platinum before going out on his own and establishing Antipodes. Antipodes has been doing particularly well in a very short space of time and has been certainly one of our best performing managers with FGG. So without further ado, please welcome Graham. Thank you.
Well, thanks, Louise. I fear my story may seem a bit passé, given all the excitement around technology that's been presented so far, but let's see how we go. So the company we're talking about today came into our radar last year as a result of what we describe a market dislocation event. It was a failed merger between the two largest office supply companies in the United States, where the competition authorities ruled that the merger would be too significant for the customers to bear. And it's often the case with market dislocation events. You get a separation of price from fundamentals as the parties that are involved in the shares during a merger have to liquidate their positions. And so it was with Office Depot, whose share price or valuation during the merger was touted at around $8 billion, compared to a valuation today, as we speak, of around $2.5 billion. As I mentioned to you, it's one of the two largest players in the office supply industry in the US. That market today is already very consolidated, 75% market share held by those top two players. And Office Depot should do annual sales this year of around $11 billion on a market cap of $2.5 billion. It has net cash on the balance sheet. So you can see the sort of potential latent value that's represented in this business. But look, why would anyone be interested in office supplies? Surely this is a dying company in a dying industry. And indeed, that is the prevailing consensus view amongst the sell side, where 95% of opinions are either a hold or sell. In fact, there is just one single buy rating on this stock, which in my experience in the US market is very unusual, unless you're on the teetering on the edge of bankruptcy, which is certainly not the case. But look, US retail, as we know, has and continues to be a very tough place to operate. And so it's with some caution you may look at this name. But the truth is, office supply as a business has been tough for a long period of time. And it's not without good reason that the industry is consolidated down to two players. And those two players have survived and are around today because they have developed very refined e-commerce, logistics, and supply chain capabilities. And in essence, I think that is what you are buying today. You are buying the platform that is enabled by those investments. Unlike lots of companies in retail who are yet to feel the effects of Amazon or are just dealing with the emergence of Amazon into their business, with 2/3 of sales already online today and over 1,400 distribution points across the country, one might argue that both Office Depot and Staples are already the Amazon of the office supply industry. And in fact, a point to note is the fact that Office Depot price match Amazon on all of their products. So the impact of Amazon is already felt in the sales, the margins, and therefore the multiple that's applied to the shares today. So we think the Amazon effect for office supply is probably overstated. There's a new CEO at the helm. The ructions of the last couple of years meant that the prior CEO took early retirement. A new guy has come to the helm. This guy oversaw Lenovo's US operations as the chief operating officer for the prior decade. If you know anything about Lenovo and the PC industry, you know that there's nothing that's not more cutthroat than selling PCs, particularly when you go in as a foreign competitor into the US market and you take on the likes of Dell and HP on their home turf. Lenovo's achievements in the US and indeed globally over the last decade are extremely strong. And we think this guy's pedigree is very right for the situation at Office Depot. But the platform I mentioned is interesting because what it means if you've developed this type of logistics and e-commerce platform is you can start to think about adjacencies to serve rather than just the core office supplies business. So we think there's lots of opportunity for Office Depot's new management to address new categories. They have a very deep business-to-business capability inside the company. 2/3 of sales go to corporates, and corporates obviously demand a lot more than just office supplies. So things like sanitation, janitorial supplies, kitchen, and the like are new areas they could serve. The CEO's experience in electronics will also be brought to bear. There's a whole bunch of categories that the company could potentially address from that as well. And I'll just finish up on this one point on valuation. We think the business is capable of doing 80 cents a share in EPS in 2018. It puts it on 6.5 times earnings. As we speak, there are a gaggle of investment bankers walking around Australia pitching to offload Office Max from Wesfarmers. That asset has been pitched at around 12 to 15 times earnings, and that's before Amazon have arrived. So if one of those prospectuses lands on your desk or in your inbox, maybe consider that fact in your thinking. Thanks very much.
Thanks very much, Graham. So there you are. We've had our first 6 fund managers present their stock picks. So we're halfway through, and hopefully you've got some interesting tips there to go away and do your due diligence and whatever else you do following today. So now we'd like to break for some afternoon tea. So if any of you want to corner one or more of those fund managers, please do so. And we'll be back here just short of 2 o'clock, please. Thank you. Good afternoon, everyone, again, and welcome to the second half of the Future Generation Investment Forum. Hope the afternoon tea was okay. Did they give you a decent bicky? I don't know. Did they not? Oh, gee. Okay, right. Well, we'll certainly be fixing that next time. Apologies about that. I've actually bought one of mine. I've got my own one in there. Okay, so to kick things off for the second half, I'd like to introduce our first presenter, Nikki Thomas. And I'm absolutely delighted that we're also welcoming a female fund manager to the stage as well, our one and only today. Unfortunately, we might change that for next time. But Nikki Thomas is from Magellan Asset Management, which is one of our FGG fund managers, and Nikki is the head of research and is a portfolio manager. She joined Magellan in 2007. Nikki tells me that in her spare time she helps manage her plant nursery on the south coast of New South Wales, and she also rides a 650cc motorbike as well. So please welcome Nikki to the stage.
Hello everybody, it's lovely to be here. I'm very glad to be a female too. Who's going to do that bit for me? Me? There we go. Okay, so before I start, firstly, if I could just say thank you to Louise and her team very much for including Magellan as part of the FGG investment portfolio. I'm going to talk about a company that you've probably never heard of, so stick with it. Before I start though, I want to make one important point. Magellan runs a portfolio of stocks. This happens to be our largest investment in that portfolio. And our mission for people out there is to minimise the risk of a permanent capital loss, so preserve your capital and also make a return. And we run a portfolio of stocks to do that. So it's very important to think about this in the context of a portfolio, not just as a single stock. So of course, Apple is the largest company in the world. And as the slide will tell you, this is pretty much about the iPhone. So about 75% of the gross profits of this business come from the iPhone, and another 12% come from services. So services, all those things you do on your phone, using iTunes, Apple Music, the App Store, and so forth. So they make money out of that as well. And of course, if you're using Apple Pay, they're making money out of that as well. So that piece is growing rapidly and is a very important part of the puzzle in understanding this business. But I think the mistake most people make with Apple is they think of it as a hardware company. It looks like a hardware company. It sells Macs and phones and iPads, but actually it's a software company. It's the software piece that actually makes this business sing as an economic model. When you think about the software piece, you have to think about what it is that iPhones represent, and they're a smartphone. In the world today, there are 2.6 billion, 2.7 billion, in fact, smartphones out there in the marketplace. That's against a population of 7 billion people in the world, so there's still a lot of room for growth, but it's a lot of phones. Who operates? Who's the operating system inside those phones? Well, 98.5% of those phones are run by just two operating systems. One is Android, which is owned by Alphabet. They have about 80% market share. And almost all the rest is Apple's iOS. So it's the iOS operating system that is what is very important to understand when you think about why Apple is a valuable business. So you've got a smartphone in your pocket and you use it for just about everything. Who doesn't have a smartphone in their pocket? Okay, there's two hands. And when you're doing that, you're obviously very engaged with your smartphone, whether it's an Android operated or an Apple phone. Indeed, Apple phones have a user retention that is over 90%. I think it's about 95%. People love their iPhones. And they don't love them because it has a great camera compared to a Samsung Galaxy or because it collects their email beautifully. They love it because of the ecosystem that comes with being part of an Apple ecosystem. They love that when their phone gets dropped down the toilet and they can't retrieve it, they go to the store and they get a new one, they log in, and all of those apps they've already bought are already there. So the whole system works for you. You can talk to your friends on FaceTime. You become part of an ecosystem, which means when you buy a new phone, you're effectively paying to be part of something. It becomes a subscription to an ecosystem. It's not just about the value of the phone, it's that you're staying a part of that, and you tend to stay a part of that, and if anything, more and more people are becoming part of that Apple ecosystem. If you look at what this company does in terms of sales of iPhones, what you see on the chart up here is the amount of sales to people who are actually part of the system already continues to grow dramatically. So replacement phones, when you have to replace your iPhone every 2 or 3 years, is an increasing part of the revenue streams for this business. And indeed new phones, is less and less new phones needing to be sold because you're increasingly just working on that 500 million install base that Apple already has. So their ability to monetize that over time as they continue to sell phones to the existing user base and then have you use those phones and make money out of the use of those phones has become very, very persistent. This business has an incredible economic moat around it, and it has a revenue stream that you can see coming back to it year in, year out for many, many years to come. So you would think this would be a very expensive stock given it's got an 800 billion market cap. Well, indeed, if you pull out the fact that it has $135 billion of net cash even after you tax that, and you pull out the value of the services piece, which is over $200 billion worth of value, you're paying about 12 times for Apple today. 12 times. So we think this is astonishingly good value. The biggest problem you people have is when would you sell this stock? And so I'm going to give you one other stock tip here today. I can't come back and tell you when it's the right time to sell it, but I know people who do know when to sell it. And if you buy MGE, which is the Magellan Global Fund, which owns Apple and a lot of other business like this, we'll do that work for you. Thank you very much.
Thank you, Nikki. I am one of those Apple addicts myself, and she did mention iPhones and toilets, and I actually did that last Monday. I actually dropped my iPhone down the toilet and I was in the worst mood for about 24 hours, but Sam, who works for Jeff, got me that new phone and everything was in order and my life just recovered like that. But I was quite depressed and wasn't very productive on Tuesday, I think it was, when I got back to work. So thank you very much, Nikki. Lovely to have you on board with us, and also thanks to Magellan for the fantastic work that you do for FGG. Now, our second presenter this afternoon in the second half is David Prescott. And David Prescott is one of our FGX fund managers. He's based in Adelaide, and David is the founding director of Lanyon Asset Management, a value-oriented equity fund manager which was established in 2009. Perhaps the only thing that Dave loves as much as finding a good value investment, and his family of course, is seeing his beloved Port Adelaide AFL team winning a game of footy. And I'm glad to see that Port Adelaide whipped the Gold Coast Suns in Shanghai on Sunday, which of course created history by being the first AFL game for competition points that was held outside of Australia and New Zealand. So please welcome Dave to the stage now. Thanks, Dave.
Hi everyone, and thank you Louise and Jeff for the opportunity to be part of Future Generation. It is an enormous privilege, and to be involved even in a small way with the enormous contributions you're making to your charity partners. Wrong way. So today I wanted to talk about the most significant shift that has occurred in the Australian print industry for over 2 decades, specifically an event that occurred in the last few months. That event was the consolidation of the Australian catalogue printing industry to just 2 players, the formation of a duopoly. We think that will lead to the delivery of much improved returns for the sector. Over the last 10 years, there's been significant structural change in the Australian print industry, with all players being impacted by the substitution of physical print to distribution of content through digital mediums, like the Apple iPhone or a smartphone or other smartphones, emails and tablets. Catalogues, however, have been an incredibly resilient component of the Australian print landscape. Despite the broad reduction in printed volume that has occurred widely in Australia across multiple publications, we continue to print over 7 billion catalogues a year here in Australia. These are the catalogues that fall out of your weekend newspaper or are stuffed in your letterbox when you come home every single day. They are a staple part of a retailer's advertising spend, and, to put that another way, we print over 130 million catalogues every single week, and this number is still growing modestly. Over the last 5 years, as the broader print industry has suffered from declining print volumes, the resultant excess printing capacity has manifested itself in intensive competition, declining pricing, and a savage reduction in industry profitability. Let me put some colour around that because we think it's important. Over the last 5 years, we estimate that the average print pricing has fallen 25%, from around $1,900 a tonne to around $1,400 a tonne. And, as a result, the catalogue printing industry profit pool has halved from about $250 million down to about $120 million. This reduction in profits is due almost solely to the deteriorating price environment, as catalogue volumes have been broadly stable over that period. Last year, there were two important and significant developments. ASX listed, going the wrong way, sorry. ASX listed P&P Limited, which is Australia's largest and most efficient printer, was cleared by the ACCC to merge with its major competitor and the second largest player in the industry. Around that same time, another ASX listed company, the IVE Group, orchestrated a merger between the third and fourth largest player. What was a fiercely competitive and dysfunctional market has now formed a duopoly. So we all know that buying shares in companies that operate in functional duopoly industries can often lead to spectacular investment outcomes. Where you have limited price-based competition and an orderly environment, it can drive strong shareholder returns. In Australia, you'll remember the returns that have been generated from Woolworths and Coles over many years, or Lion, Nathan and Foster's are two classic examples. In isolation, a duopoly market environment doesn't guarantee success or a ticket to riches, but a rational, orderly and well-performing duopoly is certainly a very good place to start. To put it another way, the current industry structure is a darn sight better than the brutal price-based competition that has decimated industry margins over the last 5 years. Over the next few years, we expect a rational environment between IVE Group and P&P, an orderly pricing environment, and a gradual restoration of the industry profit pool. Remember, only 5 years ago, pricing was 25% higher and the industry profit pool was 200% higher. We feel the best place to invest in this industry is through P&P. It's Australia's largest, best capitalised, and despite popular perception, Australia's most efficient printer. We don't invest in IVE Group at Lanyon, given our concerns about management succession and their highly leveraged balance sheet. Remarkably, despite being the market leader with a significantly stronger balance sheet, P&P currently trades at half the valuation multiples of IVE. At Lanyon, we started buying P&P 4 years ago when the price was 15 cents. This is the first time we've spoken publicly in detail about our investment, but since our initial purchase, the stock has subsequently gone up 4 times, and this is despite that challenging economic and industry dynamic. Whilst this is a very decent return, with an improved operating environment and a current valuation for P&P that still remains compelling, our view is that P&P investors can look forward to strong returns in the years ahead. So finally, let me walk you through those numbers and the valuation as we think they're compelling. At the current price of 64 cents, P&P's market cap is $320 million. Given the strong cash flows that will continue to be generated from this business, we expect the company, post the merger and all the subsequent integration one-off costs, will be debt-free by June next year, so within 12 months. The company is forecasting EBITDA in 2019 of $95 million, which I should point out assumes the maintenance of the current pricing environment and doesn't incorporate any recovery in pricing. We think that is an incredibly conservative position. A $100 improvement in average print pricing, you will recall from my earlier comments, would increase EBITDA by over 25%. So given the modest capital expenditures and working capital requirements and the company's enormous pool of tax losses, which will shield them from any cash tax for many years, we expect free cash flows for this business to be in excess of $80 million or over 17 cents a share. Given that expected debt-free balance sheet, the company is committed to returning this cash back to shareholders through dividends and share buybacks. And with the $60 million pool of franking credits, we expect the near-term fully franked dividends could be easily greater than 8.5 cents a share, implying a fully franked cash dividend yield on current prices in excess of 13%. We think PMP is flying under the radar and the stock market has failed to grasp the significance of these recent developments. Surprisingly, despite the announcement of the ACCC approval and a recent string of positive announcements demonstrating the very significant and tangible realisation of cost savings through press and site closures at PMP, this amounts to earnings upgrades, the shares have continued to drift lower. We think there is a significant price and value anomaly on offer here, and in our view, PMP shares are worth in excess of $1. We expect the price of PMP will move towards $1 over time, and investors will again take notice as these dividends start to flow. That implies a potential return at current prices in excess of 50%. Thanks.
Thank you very much, David, and also thanks to Lanyon for your support for FGX. And I know, as Jeff said, you were one of the fund managers that were keen on us doing this sort of event today. So thank you for giving us a nudge on that front as well. So next up we have Chris Dixon, and Chris is from Cooper Investors, who are a fund manager in both FGX and FGG, along with Paradise actually. They're the two fund managers that are actually in both of our companies. So we're incredibly grateful to Peter Cooper and to Amanda Perry and the team at Coopers, including yourself, Chris, for your support for FGX and FGG. Chris joined Cooper Investors as joint portfolio manager in November 2011, and as a member of the global equities team, he focuses on European and Japanese companies. Chris tells me he balances living in a very feminine household with 3 daughters, think frozen dolls and pink things everywhere, literally, with his blokey interests, which are motorbikes, so I'm sure you'll have fun talking to Nikki, and Hawthorn, so good to see Hawthorn have a win on Saturday as well. So please welcome Chris. Thank you.
Thanks, Louise, and good afternoon, ladies and gentlemen. So when Louise and Jeff asked me to do this, choose one stock out of a carefully constructed portfolio to talk about for just 5 minutes, it's actually quite difficult. It's like being asked to pick a favourite child. As Louise says, I've got 3 daughters and they all think they're the favourite, which of course they are. So I've chosen, after a bit of thought, Diasorin. Now, this is an Italian mid-cap diagnostics company. Why Diasorin? Well, we think it's got one of the best business models we've ever seen. It's also in an industry that has long-term secular growth, and it has an owner-manager and owner-chairman that have significant personal skin in the game. Now, this is an Italian hidden champion, okay? You can't visit them in Milan or Rome. They're not in the main Italian stock index. You can't go and see them at a London healthcare conference. No, you have to drive 2 hours west into the rural Piedmont countryside to visit these guys. So what do? They make and sell immunodiagnostic machines and test kits. Okay, now that sounds very complicated, so I'll try and simplify it for you. I'm sure everyone in this room has had their bloods taken, probably on many occasions, and when that little vial of blood gets sent away to the pathology lab, it gets separated out into a dozen or so smaller glass tubes called assays. Now, into those assays are pipetted chemical reagents. Each reagent is distinct, testing things like flu, vitamin C deficiency, HIV. Now, what's beautiful about this business isn't the machines that Diasorin sells that do the tests, but it's these reagents that go into them. This is a razor blade business model, okay? Once you've got the machine in the lab, you have to keep reordering these reagents from Diasorin. In fact, the CEO likens this business to an ATM in a lab. It's almost 100% recurring revenue. Now today, Diasorin has an installed base of around 7,000 of these ATMs and labs around the world, and that installed base is growing around 6 to 7% a year. The growth is coming from, firstly, new tests being added to the menu. So recently the company had approved the world's first automated Zika virus test. Secondly, it's emerging markets, the growth in the healthcare systems in places like China, new hospitals, new pathology labs. Diasorin's grown 30% per annum in China for the last 2 years. And thirdly, it's the miniaturization of the machines. So the current device is around the size of a piano. The next generation device will be half the size and fit on a bench top, which means that they'll be able to market it to the 50,000 or so smaller physician labs worldwide. And if they can get the current level of market share with the new device, that actually doubles the installed base. So a very, very simple and cash-generative business model, an exciting growing industry. But you know what really gets our juices flowing at Cooper Investors is culture. Now, I've been to visit Diasorin 3 times, most recently in March, and I can tell you this company has a special culture. It's been based near the town of Salujah for the past 30 years, and it employs multiple generations of the townsfolk. You know, you walk around the grounds with the CEO, Carlo Rosa, you can really feel the passion he's got for this business. He did a management buyout in 2001. He couldn't afford to do it himself, so he enlisted the help of a fellow Turinese by the name of Gustavo De Negri, who had just sold his stake in Piaggio, a company he would better known for making scooters. But Gustavo is, like Carlo, actually a biochemist. Today, these guys have taken a company from 100 million in revenue in 2001 to 600 million today. They've multiplied net profit by 5 times and delivered 600% total shareholder return. Today, Gustavo owns around 44% of the company, and Carlo owns around another 10% and has never sold a single share. So with these guys running the show, there's no debt on the balance sheet, by the way. We have very strong confidence in them continuing to focus on this big growth opportunity they have, remaining focused and disciplined on capital allocation. And we think this company could be worth around 90 euros a share by 2020 versus 70 today, which, including dividends, implies around 10% shareholder return growth per annum. And the final little juicy piece in this story, if and when they decide to sell the business, well, last year German Merck paid 20 times EBITDA for Sigma Aldrich, which gives you some idea what people will pay for a good reagents business. I think that's all my time, so I'll thank you for yours, and good afternoon.
Thank you very much, Chris, and I wouldn't mind going along with you on your next visit to Diasorin. Fascinating. I like that one, so thank you. A little bit different too. Like the simplicity of the slide too. Very good. I've got a special clap over there from someone. Okay, well next up, join with me in welcoming Adrian Warner. Adrian is the Managing Director and Chief Investment Officer of Avenir Capital, which is one of our fund managers for FGG. Adrian founded Avenir in 2011. Adrian is an avid cyclist, and there's a bit of a theme going on here. I think we've got quite a few cyclists in the funds management industry. I know Jeff is an avid cyclist, but you've certainly heard, there's certainly some AFL obsessive fans as well. So please welcome Adrian. Thank you.
Thanks, Louise, and it's a pleasure to be here and a pleasure to be part of the future generation investment family. The company I'll talk about today is Nexstar. And Nexstar is a US local broadcast affiliate. So they take primetime TV shows such as The Big Bang Theory and 60 Minutes from the big 4 US broadcasters and package it up with local content, including local news, sports and weather, and broadcast it from 179 local stations they own across the country. Their content is distributed primarily via the cable companies through which Americans access TV. We think Nexstar is an interesting investment opportunity because investors are more fearful of certain things than we think they should be, and they don't fully understand some of the positive aspects of this investment story. So what are they scared of? Firstly, they're scared that the rise of digital advertising and streaming services such as Netflix and Amazon Prime will cause TV advertising revenue to dry up, reducing profitability. The data shows, however, that unlike newspaper and magazine advertising, TV advertising revenue has actually grown as a percentage of total advertising spend, which is in itself growing. So we think Nexstar's traditional advertising revenue is a lot more robust than people think. The second thing investors are scared of is that cable TV is going to suffer reduced subscriber numbers over time, also because of streaming media. In response to this pressure, the cable TV industry is offering so-called skinny bundles, where they offer packages of fewer channels at a much lower cost. And we've found that even in the skinniest bundles of only 20 channels, you always find the 4 local TV stations because people want them. So now you're only competing against 16 other channels instead of 400. So the trend towards skinny bundles actually increases the relative importance and the competitive position of the local channels. Even better, many of the streaming services, such as Hulu and Amazon Prime and Apple TV, are actually adding the local TV stations to their streaming services as they recognise the persistent demand for these local stations from their customers. Another very positive aspect of the business that we think people don't fully value is its relatively new and high quality revenue stream. About 10 years ago, the CEO of Nexstar realised that the cable companies were not paying anything for the content provided by Nexstar and other local TV providers, despite paying everybody else for their content. So Nexstar started demanding that they get paid for their content, and they have been getting paid. It's an entirely new revenue stream that has grown over 10 years to now make up almost 50% of total revenue. It's recurring, non-cyclical revenue, so it's even higher quality than their traditional advertising revenue, and it's going to experience double-digit growth for the next 5 to 10 years, as even now the local broadcast channels still only make up 10% of the content cost paid by the cable companies, while making up 40% of the viewing time of their customers. So there's a long way to go for the Nexstars of the world to get paid their fair share. So you're all sensible investors, so I know you're all thinking, what about the price? Well, Nexstar acquired another company at the beginning of this year for a combination of shares in cash. So it's now we see it as a private equity style deal in the public markets or a public LBO. And the company is absolutely gushing cash. For every $1 of revenue, they generate over 20 cents of free cash flow. That's cash flow available to shareholders after expenses, taxes, capital expenditure, after everything. Now, the company's making about $12 per share of free cash flow per year, and it's currently trading at about $60 per share. So if you buy Nexstar today, you're earning a 20% return on your capital. And just as a comparison, the S&P 500 today is trading at something like a 4% free cash flow yield. So if we split the difference and value this company at a 10% free cash flow yield or 10 times free cash flow, Nexstar is worth around $120 per share, which is a double from today's price. So we think people are overly focused on certain aspects of the Nexstar story and don't place enough value on a lot of these very positive aspects of the story. It's generating huge amounts of cash. All of this we see as being available to us at half price. And since we submitted the slide, the share price has actually fallen a couple of dollars since we put the slide up. So how wonderful for all of you to be able to buy this even cheaper now. That's the Nexstar story. Thank you.
Many thanks, Adrian, for that great presentation. So now we're coming to near the end. So I think we've got 2 to go. So next up we have Michael or Mike Dwyer, and Mike is from Neuberger Berman. Special thanks to Mike because he's travelled from Hong Kong, where he's based. So hats off to him for making the special trip. Mike is Senior Vice President, Client Portfolio Manager for Equities and Alternatives at Neuberger Berman, who are one of our fund managers for FGG. Mike is into Thai boxing and CrossFit. He grew up in London and he moved to Hong Kong 2 years ago. He tells me he's got limited knowledge of Australian sports, but he did try and watch an AFL game once at the MCG, He enjoyed the pies, but he couldn't quite work out what was going on the field. So please welcome Mike to present his stocks. Thank you.
Thanks very much. It's a pleasure to be here. I was going to present two stocks from Neuberger's wide repertoire of holdings, but I think in the brevity of time, I'm just going to focus on one because there's quite a lot to say. And we all know the story of the ugly duckling. And what I'm going to talk about today is a stock which this time last year was an ugly duckling. I'm going to talk about Whole Foods. Now, Whole Foods, for those of you who aren't familiar with it, is a US grocery chain, an upmarket grocery chain. Fresh food, organic food. It's expanded rapidly in the last 10 years in the sort of vanguard of the healthy living, food integrity boom that's come through, particularly America, but more globally. But this time last year, everyone hated this stock. I mean, analysts hated it, hedge funds hated it, the press hated it, the market hated it. Had 15% short interest, only 4 out of 28 analysts had anything interesting to say about it. Its stock price had fallen from $65 in October 2013 to about $28 this time last year. But we liked it. Not only did we like it, but we bought it. And we made it biggest position in one of the portfolios that we run. Where's Whole Foods today? Today, it tags itself as America's healthiest grocery store. It has 464 stores in 3 countries. It employs 87,000 people, serving 30 million customers, generating just under 16 billion in revenue, and a market capitalization of about 11.7 billion. But there's a problem. America's healthiest grocery store is sick, or it was sick. The problem with Whole Foods is it expanded too quickly. It fell into the lovely position of being in a secular growth story without a management team who really understood Retail 101. So what you've had in the last 3 to 4 years is you've had falling same-store sales. You've had increased competition from the traditional supermarkets in the US. You've seen the management be reluctant or sort of insipid in initiating change in response to this. But sometimes, as the analyst who covers this stock said to me, sometimes things are so bad that they're good. When you stripped away all the negativity around the stock this time last year and you looked at the model that Whole Foods really had, you found a company that had, if not the best brand recognition out there, an exceptionally loyal customer base. And it had simply never done the basics of retailing. And when I say never done the basics of retailing, it had grown through a series of smaller acquisitions. It didn't have a unified point of sale technology. Can you imagine being a grocery chain without a unified point of sale technology? You can't change prices very quickly. You can't run a customer affinity program. So you've got these loyal customers, but you can't monetize it to the most efficient level because you can't run a loyalty program. It had opened stores without really thinking about the impact on its existing stores. It had been pretty much a growth at all costs measure. Interestingly, the shareholder base had shifted from being growth investors to value investors, and this stock was really in the doldrums. But as I said, we liked it. We thought it could be fixed. So at Neuberger, we characterize ourselves as active rather than activist investors. So in September last year, behind closed doors, we wrote to the management and we outlined the points that we'd like to see changed. A change in governance, a change in operating performance, operating measures to create in performance, and a readdressment of thinking about some strategic alternatives for the business. That was September last year. We've seen some changes. So we've seen a replacement. They had a co-CEO structure, which was kind of inefficient and very expensive. We've seen the CFO retire and be replaced. We've seen the right noises about engaging on understanding their customer base better, instigating a unified technology platform, launching an affinity program. Started to see progress. And at the beginning of April this year, a hedge fund called Jana Partners, we own about 3% of the company. Jana Partners came in and bought 8%. They'd seen pretty much the same thing as us. Now, Jana are a much more aggressive activist investor. They went public straight away with a 13D filing and said, we want to engage management to talk about capital allocation, corporate governance, and potential strategic alternatives to the business model for Whole Foods. Stock popped 30%. Since then, just last week, and this is why I switched from talking about 2 stocks to 1 stock, because there's a lot more to say. Just last week at Whole Foods' second quarter earnings announcement, they talked about changing their strategic initiatives for the year. So they changed their 2020 guidance and their 2020 business plan. They replaced 5 members of the board. That's quite a lot. Turnover of 5 people in the board is pretty high. So they replaced 5 members of the board with people with better retail experience. And they initiated an increased dividend and an increased share buyback. We still think there's more to go in this stock. This stock, in our opinion, is now on a dual path. It will either be fixed by the current management, or it will be fixed by some kind of strategic alternative, i.e. it will be taken out by a purchaser. Now, when Jana got involved, they were offered 2 seats on the board with a standstill agreement. So what that basically means is you can have 2 people on the board, but you won't cause us any more trouble. They declined that. And we take that as a sign that they think that there's a purchaser out there if the management don't get their house in order themselves. So in short, Whole Foods has a great business model, great business brand penetration with a hugely profitable demographic, this sort of middle to upper middle income American consumer. Even with a small amount of change in macro, i.e. a little bit of return in food inflation, they're going to see their top line increase. But there's an immense amount of very basic retail stuff they can do behind the scenes to create increased earnings in this stock. So I just wanted to focus on 1 stock today and talk about Whole Foods. This is, as we show on the slide, we've been quoted in the Wall Street Journal, the New York Times. We've been on Bloomberg, we've been on CNN talking about this stock, and Charles Cantor, who's the lead manager for the portfolios in, is well versed on this. We don't see ourselves as agitators for change. We work with management rather than against them, but we do see this as an opportunity where there is something very tangible that a company can produce to create real value. So right now this is trading in the mid to late 30s, sort of $37, $38. We see at the very least $45, $46 for this stock, potentially more over the long run. So we're getting very excited about what we considered was a broken growth story. So when I talked about ugly duckling last year, we're not quite yet bloomed into the swan, but we're getting there. So thank you very much.
Thanks very much, Mike. And I'm a bit of a fan of Whole Foods. I mean, when I'm in New York, I actually stay somewhere that's right next door to one, so I'm always in there. So thank you, and thanks for making the trip, especially from Hong Kong as well. We very much appreciate that. So to round things out this afternoon, I'd like to welcome Chris Stott to the stage. And Chris is the Chief Investment Officer and Portfolio Manager for Wilson Asset Management. So for those of you that are Wilson or Asset Management or WAM shareholders, you'll be very familiar with Chris, and he's been up here this morning with the WAM shareholder update presentation. Chris has more than 14 years experience in the funds management industry. He's an avid AFL fan himself, particularly the Swans. And his little story, which is quite fun, is that he once kicked for goal at Etihad Stadium in Melbourne, hitting the post. So it was a kicking competition at half-time at an Essendon game when he was 22. And I must say that Chris has certainly been kicking plenty of goals since he's joined WAM. So fantastic to have you here, Chris, and welcome. Thank you.
Thanks very much, Louise, and thank you for including me on such a wonderful day, and it's a privilege to be a part of such a great event. So thanks to Louise and Jeff for the invitation. It's very often as fund managers and as analysts, we get trained to invest against the pack, never run with the herd, always go against the tide. And that's some advice that was sort of instilled into me as an investor years ago, and all of the team at Wilson Asset Management, and it sticks with me today. So the company I've got to talk about today is a microcap. It's listed here on the ASX. It's got a market cap of around $200 million. It's cheap. It's on a PE of 13 times, growing at 10%. It gives you a return on equity of 30%, and it's going to generate anywhere from $10 to $30 million of free cash flow per annum over the next few years. So all the numbers stack up. The company that I'm here to talk today about is Reckon. Now Reckon, for those of you who don't know, a bit of history on Reckon, they are predominantly an accounting software provider. They listed in July of 1999. They have been a well-run business for many, many years. Their historical relationship was with a company called Intuit in the US, who own the QuickBooks accounting software, who gave the license to Reckon many years ago to sell the QuickBooks software in the Australian market. Now, that went very well for Reckon over many, many years, and then Intuit around in 2012 decided that they'd bring that licence back in-house. They decided that they wanted to sell into the Australian market themselves and go direct with their QuickBooks Online software. So that was a significant moment in time for the company Reckon and for its shareholders and for the investors alike. And what you've seen since then is the company has really struggled to an extent to really get any traction in the accounting software market. What they've done is they're trying to go it alone. They've created this own product called Reckon One, which is their own piece of accounting software that they're spending tens of millions of dollars on a year to really drive and create a piece of market share in the Australian market in that cloud offering. Now, for accountants out there who use software, there's a massive shift out there at the moment to what we call cloud software. Historically, you've walked into, say, a Harvey Norman or an Officeworks, you've bought your CD in MYOB or in QuickBooks, and you've done your accounting on what they call the desktop. That's now shifting from the desktop more to the cloud, where companies like Xero and MYOB, to an extent, have all got cloud offerings now these days and are the market leaders in this particular segment. Reckon, however, as we said, are continuing to invest in their product, trying to carve out a piece of market share in this very competitive cloud space market, which generates very, very high returns over time. So that's the Reckon One product. The key message which I'd like to leave with you today on Reckon is that they've got a second part to the business with another piece of software, practice management software called APS. And that's used by mostly professional firms, companies like Pitcher Partners and the like, who use that internally really as a database to help manage their clients and a more efficient way to do business effectively. That APS piece of software is the most underappreciated asset within Reckon. In our opinion, the Reckon share price today is $1.65. We think that the APS business by itself, which generates around 50% of the earnings, can be worth around $2 per share, so more than what the company's share price is valued at on the ASX today. So we think that over time, as people continue to grasp and get a hold of the inherent value in that APS business, that will continue to drive the share price of Reckon higher. We think that you're basically getting the rest of Reckon for free outside of that APS product. So where to from here for Reckon? Back in late of 2015, the company embarked on a sale process, a very public sale process, where there were press reports around the company being for sale. And it came through the press in various articles over a few months there back in late of 2015, where it was touted to be that the whole business was for sale. Macquarie Bank ran the process. It was touted, according to press reports, that there was only one bidder for the company, an unsuccessful bidder, obviously, with Reckon continuing to trade on the ASX today. So this one is a classic sum of the parts breakup scenario, in our opinion, where you've got the business division, as they call it, which is the Reckon One accounting software, and the old Intuit code, the old 100,000 subscribers which continue to use that particular piece of software, which is also a valuable asset to someone else. You've got the APS product, which I've spoken about, which is obviously a much higher, it's worth well north of the current share price over time. So remains to be seen which strategic path Reckon take from here, given that they've had mixed success so far in terms of investing in their cloud offering, being Reckon One. So we think that Reckon is incredibly undervalued. We value it well north of $2 a share. Our interests are aligned. We, as investors at Wilson Asset Management, we own, full disclosure, we own almost 10% of the company. We're right standing next to the CEO, Clive Raby, who owns just under 10% of the company as well. So we think our interests are very much aligned, and we think as the market continues to appreciate this undiscovered gem, and as our founder at Wilson Asset Management, Jeff Wilson, calls them, we like to find these companies that start as ugly ducklings and turn into beautiful swans. And we think Reckon is one of those particular investment opportunities, and to us it's quite compelling at the moment. So thank you very much.
Thank you very much, Chris, and that was a bit of a gem to finish on, so we very much appreciate that. And also, I must do a special shout out to Jeff, Kate Thorley, the CEO of WAM, and Chris as well, because the support that WAM provides for the future generation companies is quite extraordinary. They're really the backbone support behind the scenes that makes a lot of it happen, or most of it happen, so thank you. Before I introduce Belinda Hutchinson, who's the chairman of FGG, to do a wrap and some thank yous, I just want to let you know that we will be sending you an evaluation survey. We really want to hear what you think of this afternoon. Please be brutally honest with your surveys, and if you're more than welcome to email me with any suggestions as well at louise@futuregeninvest.com.au. But just by a quick show of hands, if we did this event again next year, would you come? Okay, that's pretty good. And would you recommend it to a friend or friends? It's good as well. I think we're going to look at doing an event in Melbourne, this same event in Melbourne in November, so please make sure you spread the word to any friends or work colleagues or family in Melbourne as well. I really want to thank the presenting fund managers, for their support for the future generation companies and for being here this afternoon as well. And following this, Jeff Wilson and I will present the latest shareholder update presentation on FGX and FGG. It's due to start at 3:30. We might even see if we can get that started a little bit early if possible. But that's where you'll hear a very detailed report on the performance in particular of what's happening with both companies. Now I'd like to introduce Belinda Hutchinson, who's the chairman of Future Generation Global Investment Company, and to do a wrap and to do some thank yous as well. Thanks, Belinda.
Thanks, Louise, and what a fantastic afternoon. Speed dating with fund managers probably doesn't sound that sexy, but I actually found it really, really exciting, and I thought they did an absolutely extraordinary job. Every one of them, I think, demonstrated so clearly why we, FGG and FGX, are so fortunate to have them as the fund managers who actually act on behalf of our shareholders. They had some great insights. As you can tell, the depth of analysis that they have done on each of the individual stocks that they showed us applies across their portfolio. And I'm incredibly grateful to them, and I know that my board of directors, I know my shareholders are incredibly grateful for them for coming along today. And I'd also like to thank all of the fund managers who support Future Generation Global and Future Generation Investments. They really are doing something very, very special for us in terms of providing us with an opportunity to be a dual-purpose listed investment company. And in terms of FGX, being able to help kids who are really at risk. And for those who are shareholders in FGG, we're able to support those young people and children who suffer from mental health issues. And the numbers, when you see them, are absolutely distressing, but we can really make a difference because we are giving away millions of dollars now a year because of the fund managers' generosity in terms of giving up their management and performance fees. So I really, really would like to have a round of applause for our fund managers, not only those here today. I also have to say a couple of extra thank yous. Now, Louise has already thanked Kate and Chris and Jeff, but I also have to thank Louise. Louise has put together with another team of people this afternoon's event, and I know, and I think all of those who've been involved in putting together AGMs, investment forums, conferences, know how much work goes into something like this. This has taken 6 months to organise, and Louise, you have done a stellar job, absolutely stellar, and I do have to just remind myself who else was involved. James McNamara, Alexandra Hopper, Natalia Mizwa and Alison Shave have been absolutely fantastic in getting this thing done today, and I just think you all deserve a round of applause, so thank you so much. And I think it's just fabulous that we've had close to 800 people here today. How brilliant is that? So please, as Louise said, spread the word about the Investment Forum. I think it's a great format. And we do have our AGMs for FGX and FGG to follow. Please stay. We'd love to tell you a bit about what we're doing, and thanks again for attending.